Silver didn't top. Silver got punched in the mouth on purpose. It ripped to the low 80s, flirted with the mid 80s, and then the market yanked the floor and slammed it back into the low 70s in a single week. And the wild part? After all that violence, it's still holding above $70. That's the event. That's the signal. That's the line in the sand the crowd keeps missing. We're not watching a metal cool off. We're watching a tug of war between real demand and paper leverage, and the rope just snapped a few weak hands off the team. Now watch this. When an asset can eat a $5 down day and still finish the year standing tall, that's not a funeral. That's conditioning. That's the market trying to see who blinks first. And if you're feeling that stomach drop right now, good. That means you're awake. Because the story isn't silver is up a lot. The story is the market just proved it can't keep silver under old ceilings anymore. You're here with us. Let's get into it. First, the move. Silver didn't drift higher. It sprinted. One strong week, a close-up in the high 70s, then a Sunday night spike into the low to mid 80s before the reversal hit like a trap door. That reversal wasn't investors changing their minds. It looked mechanical. It looked like leverage getting squeezed out of the room. You know the pattern. Price gets too jumpy, the rules change, the casino raises the cost to sit at the table. Higher margin requirements don't change the long-term trend. They change who gets to stay in the trade. And that's why the correction mattered more than the rally. A straight line up is fragile. One shove and it breaks. A rally that survives a forced deleveraging, that's a different animal. Here's the mistake most people make. They see a sharp drop and assume the top is in. But tops don't happen when everybody's still nervous. Tops happen when the room is drunk on certainty. Right now, the room is anxious, skeptical, and begging for a reason to call it fake. That's not euphoria. That's unfinished business. So let's talk about the old ceiling everybody worships. For decades, the number that haunted silver wasn't 70, it wasn't 80, it was 50. That was the rooftop. The point where every rally used to run out of oxygen. This time, price didn't just tap it, it blew through it. And once a market breaks a ceiling like that, it rewires psychology. The question changes from, will it ever break 50? To, how far can it run before it finds the next wall? Now, do we know the next wall with certainty? No. This is educational. We manage risk. But we can measure what happened. Fact. Silver launched above a multi-decade barrier and stayed elevated even after a violent shakeout. Interpretation. The market is repricing the baseline. And if the baseline moves up, the whole range shifts up with it. That's why $70 now feels like a new floor, even if price whips around above it. But there's a second clue most people are ignoring. While silver was doing backflips, a lot of mining stocks barely moved. Read that again. The metal ran. The businesses that dig the metal shrugged. That disconnect is not normal at the end of a cycle. At the end, miners go insane. They go parabolic. Everyone piles in because the story is easy and the charts look like rockets. When miners lag while the metal rips, it usually means disbelief. And disbelief is fuel. Because capital hasn't fully rotated yet. It's like watching smoke fill a room while people argue whether there's a fire. We don't need everyone to believe. We just need them to show up late. Now let's deal with the elephant that always shows up in the comments. This looks like 1980. This looks like 2011. Listen, history rhymes. It doesn't photocopy. Back then, the moves had their own fingerprints, different interest rate regimes, different positioning, different catalysts, different policy responses. A true blow-off has a vibe. It's a stampede. Right now, we're getting something else. Violent price action plus widespread skepticism. That combo screams transition, not termination. And if you want a simple filter, use this. If a market breaks a huge level and then pulls back, ask one question. Did it break because the crowd got excited? Or did it break because the underlying pressure finally overwhelmed the lid? Those are not the same. The first is a tantrum. The second is a structural shift. So what's the pressure here? Two forces, and they're both ugly. One, currency confidence. Not the dollar died overnight, not that. More like slow erosion, a leak that turns into a flood when nobody patches it. When people start doubting paper promises, they don't run to spreadsheets. They run to things you can't print. And two, industrial demand. Silver isn't just a shiny savings account. It's an ingredient. It sits in the guts of technology. It's wired into systems that keep modern life running. So when both forces hit at once, monetary stress plus industrial pull, price stops acting polite. It gets jumpy. And jumpiness is exactly what triggers the rule changes in the futures world. So the drop wasn't a vote against silver. It was the table enforcing discipline. Now watch the contradiction. If this move was truly over, we'd expect the breakout to fail hard. We'd expect silver to fall back under old resistance and stay there, humiliating anyone who chased. Instead, after a savage hit, it's still hovering above the area that used to be impossible. That's not what a dead move looks like. That's what a market looks like when it's being tested. And tests are uncomfortable on purpose, because the market doesn't pay you for being comfortable. It pays you for being early, patient, and disciplined. Now let's bring gold into the picture. Gold didn't collapse while silver whipped around. Gold dipped, sure, but it didn't break down into some disaster. That matters because gold is the big ship. Silver is the speedboat. When the ship holds steady, the speedboat can get tossed around and still be headed in the same direction. And we can't ignore what's happening behind the scenes. Central banks have been acting like they don't trust the old game anymore. They've been leaning away from certain paper assets and toward hard reserves, especially gold. That's not a meme. That's behavior. When the people who print money start hedging with metal, we should pay attention. Not because it guarantees anything, because it tells us the risk they're hedging. And if that flow continues, it quietly puts a bid under the whole precious metals complex. Now, silver is not usually the central bank metal, but silver doesn't need central banks to move. Silver needs scarcity plus narrative plus momentum, and those ingredients are starting to line up. Here's another angle. When multiple metals break out at the same time, silver, platinum, palladium, even copper pushing extremes, it smells like macro liquidity shifting. It feels like the market pricing the cost of real stuff higher. That's not a one-coin carnival. That's a broader repricing. But here's where we have to keep our heads. Not every breakout turns into a straight shot. Price can whip, price can fake, price can punish. Our job is not to predict with ego. Our job is to watch the tells. And the tell right now is resilience above prior ceilings. So let's translate the chaos into something usable. Free cash flow is cash left after the business pays for operations and investment. It's the best test of quality. For miners, higher metal prices can turn mediocre companies into cash machines fast, because a lot of costs don't move as quickly as revenue. That's operating leverage. And if we're heading into a year where metals stay elevated, miners start reporting numbers that are hard to ignore. That's when analysts who laughed at the rally start discovering the trade. They'll show up with charts and confidence, like it was obvious all along. We've seen that movie. Now, there's another story floating around. Crypto stole the spotlight. And yeah, it did. A lot of capital that might have flowed into miners and metals chased digital hype instead. But hype has a shelf life. When a crowded trade stops behaving, the exit gets narrow fast. And if that crowd starts looking for a new home, where does it go? It goes to assets with cash flows, dividends, and real balance sheets. It goes to things that look boring right up until they aren't. That's why the mining stock lag is such a big deal. It suggests the crowd hasn't even arrived yet. And that's exactly when moves get dangerous for shorts. Because shorts thrive on disbelief. They survive when people hesitate. When the rotation finally hits, the short positions turn into gasoline, and price doesn't rise gently, it jumps. Now, we need to talk about the biggest trap in this whole space. The trap is thinking every pullback means I missed it, or it's over. Both are emotional, both are expensive. A pullback after a breakout can be the market's way of building a higher platform. Imagine a skyscraper under construction. You don't build the next floors in midair. You set a base, you test it, you reinforce it, then you go higher. That's what $70 looks like right now, a platform under stress. And stress is the point. Now let me ask you something that should make you pause. If silver is finished, why is it still being treated like it's too hot to handle? Why did the market feel the need to slam it so aggressively? If it was harmless, they'd let it drift. Instead, they hit it with the kind of move designed to scare you off the screen. That's not random. That's psychology. And psychology is half the price chart. But we're not gambling, we're measuring. So what are we watching next? We're watching whether physical demand absorbs the paper volatility. Because paper can whip the price around, but it can't conjure metal out of thin air. If demand stays firm while paper players get flushed, the imbalance grows. And when imbalances grow, the resolution tends to be violent. Now, let's step into 2026 thinking. A lot of people are positioned for one of two stories. Story A, growth stays strong, inflation calms down, everything is fine. Story B, growth collapses, inflation dies, rates fall, bonds win. Here's the problem. There's a third story that ruins both camps. Weak growth with stubborn inflation. That's the toxic mix. That's the environment where safe bonds bleed and high multiple growth stocks choke. And in that environment, real assets start looking less like a trade and more like a lifeboat. Do we know that's guaranteed? No. But we can see the ingredients building. Debt loads, fiscal stress, policy incentives to keep rates from exploding, pressure to paper over pain. And when policy leans toward print and patch, hard assets tend to benefit. Now, we have to separate facts from interpretation again. Fact. Metals have been bid aggressively, and silver has made a historic breakout above a long-standing barrier. Fact. Price got hit hard, likely through forced deleveraging, and still held elevated. Interpretation. The market is transitioning to a higher price regime. Possible risk. A deeper pullback could happen if liquidity tightens suddenly, or if risk-off selling hits everything at once. So what do we do with that? We don't panic. We plan. We ask, if we're wrong, where will it show first? It will show in a failed reclaim of the old breakout zone. It will show if silver can't hold key areas and starts living back under the levels it just conquered. That's the line. Until then, the burden of proof is on the blow-off crowd, because the structure is already different. And there's one more pressure point people keep ignoring: supply policy. When big producers or big hubs restrict exports or tighten flows, the paper market can pretend it doesn't matter for a while. But physical doesn't negotiate. If availability tightens while demand stays sticky, something has to give. And what usually gives is the price. Not immediately, then suddenly. So here's the strategic mindset, not a prediction. We don't chase every green candle. We don't capitulate on every red candle. We watch the platform. We watch whether the pullbacks get bought. We watch whether miners start waking up, because miners are the earnings amplifier. Here's the leverage part nobody explains in plain English. Futures traders don't buy a full ounce with full cash. They rent exposure with a small deposit. That's margin. When price starts moving too fast, the exchange can raise that deposit. Not because the metal changed, because the risk of the bet changed. So imagine you're holding a contract and the rent doubles overnight. You either add cash or you get forced out. Forced out means selling, even if you still believe the trend. That's why these drops look like cliffs. It's not opinion, it's plumbing. And it creates a weird opportunity for anyone who's not over-levered. Because the flush does two things at once. It punishes gamblers, and it hands long-term buyers a better entry while the big picture stays intact. Now watch the physical tell, because this is where paper games get exposed. If spot dips but dealers stay tight, if delivery times stretch, if out-of-stock banners don't disappear, that's the market whispering, the real metal isn't as cheap as the screen says. Paper can print contracts. Refiners can't print atoms. So we track the gap. We track whether the street price refuses to follow the headline price. That's how we avoid getting hypnotized by one candle. And here's a question that should bother you. If silver is just a speculative bubble, why does the system keep changing the rules when it runs? Bubbles don't need rule changes. Bubbles pop on their own. Rule changes show up when volatility threatens someone's balance sheet. And when balance sheets get threatened, decisions get rushed. That's when markets overshoot. That's when the next leg gets built. Our job is to stay patient and let forced sellers work for us. Metal up 10% doesn't mean miner up 10%. Metal up 10% can mean profits up 30%, 50%, 80%, depending on costs. That's why the next earnings season matters. When those numbers hit the tape, disbelief gets expensive. Now, I'm going to give you two questions, and I want you to answer in the comments because it tells us where the crowd's head is. First, if silver is up huge but miners barely moved, do you think that's a warning or an opportunity? Second, if the market can smash silver $5 in a day and it still holds above $70, what does that say about who's really in control? Drop your take. I read them. We build this together. And quick, if you want the next update before the crowd catches on, hit subscribe. Short, simple, no excuses. Now, let's talk about what happens when the spotlight shifts. The mainstream loves a clean story. They want heroes and villains. They want one asset to worship. This year, a lot of coverage worshiped digital assets. But when the chart stops blessing the crowd, attention moves. Attention moves to whatever is working. And metals have been working. Not in a straight line, but in a way that reveals a deeper change. Capital is slowly remembering what money is supposed to do. Money is supposed to store purchasing power, not entertain you, not trend on social media, store purchasing power. And when purchasing power becomes the priority, silver gets treated less like a curiosity and more like a tool. Now, does that mean silver will definitely go to a round number? No fake certainty. But if the market has already proven it can clear $50 and defend $70, the upside case strengthens as long as the base holds. And the upside can surprise because silver is thin. It doesn't take much to move it. That's why it whips so hard. It's not a lake, it's a river. Throw a rock in a river and the current reacts instantly. Now, before we end, I want to leave you with a warning that most people ignore. Volatility is a weapon. When the market wants you out, it doesn't argue with you. It shakes you. It makes you nauseous. It makes you second guess every decision. That's the point. If you find yourself checking price every 5 minutes, that's not being informed. That's being trained. We don't let the chart rent space in our head. We look at structure, we look at flows, we look at real-world constraints, and we decide with a cool brain, not a hot stomach. Silver just sent a message. It said, I can get slammed, and I can still stand above levels that used to stop me cold. That's not the end of a move. That's the beginning of a new phase. So keep your eyes open. Watch the platform. Watch the miners. Watch the currency story. And remember, the market's loudest move is usually aimed at your emotions, not your logic. The next time you see a violent red candle, don't just ask, what happened? Ask, who needed that to happen? Because that question changes everything.